All right, so now we're going to be doing 31 through 40, the last 10. So, failed to record adjusting journal entry. Alpha has a $20,000 9-month, 12% note payable outstanding at the end of the year. The note was issued on October 1st. Interest is to be paid when the note is paid. So, we're doing an adjusting journal entry for the interest. So, they didn't do this, so it should have been a debit to interest expense, and that would have lowered our net income because it's an expense. And they should have done a credit to interest payable because we're not going to pay back the interest until we pay back the note. And that would have increased our liabilities. And here's the calculation for the interest: 20,000, 3 out of 12 months at 12%. So nothing happens to our assets because neither of these accounts affect our assets. So there's no effect. Liabilities should have been increased, but they weren't. So our liabilities are going to be understated. And this expense was never recorded, which would have lowered our net income. So our net income is overstated. All right, number 32. Failed to record adjusting journal entry. Examining the unearned revenue account, Alpha's controller finds that it includes a $6,000 for 12 months of rent received from one of the tenants on October 1st. All right, so they got $6,000 of unearned rent revenue on October 1st. So that means $500 a month for the rent. And now it's December 31st because we're doing an adjusting journal entry. So that means they've earned 3 months of that rent. So we have to do an adjusting journal entry and take that out of unearned and put it into earned. So 6,000 divided by 12, $500 a month times 3 months, because October 1st to December 31st, they've now earned 1,500. So we have to take it out of unearned service revenue, which is going to lower our liabilities. And we have to put it into service revenue, which is going to increase our net income. So nothing happens to our assets because neither of these accounts affect our assets. Our liabilities should have been increased, but they weren't. So our liabilities are overstated. And our service revenue was never did a credit to service revenue, which would have increased our net income. So our net income is understated. All right, number 33. Alpha recorded a cash purchase of inventory using the periodic inventory system, but recorded it as a debit to supplies and a credit to accounts payable. Inventory was counted in ending inventory. All right. So what they did was they did a debit to supplies and a credit to accounts payable, when they should have done a debit to purchases and a credit to cash. So supplies increased our assets, accounts payable increased our liabilities, when really purchases should have decreased our net income and cash should have decreased our assets. So let's look. Assets were increased when they should have been decreased. So our assets are definitely overstated. Accounts payable increased our liabilities when they should not have been increased. So our liabilities are overstated. And our net income was never decreased by this purchase. So our net income is also overstated. 34. Alpha made a cash sale to a customer, but recorded it as a payment to satisfy an account receivable. So let's see. They recorded it as cash received to satisfy an account receivable when it should have been a current period sale. So the debit to cash was correct, as we can see, and that would have increased our assets, which it did. And the credit to AR lowered our assets. But what they should have been doing was increasing their sales, which would have increased their net income. So now looking at assets, the cash was correct, so we don't really have to pay attention to that. But they decreased AR, which decreased assets when it shouldn't have been done. So our assets are understated. None of these accounts affect our liabilities. So liabilities, nothing happens. Then for our net income, our sales was never recorded and our net income was never increased. So our net income is going to be understated. 35. Alpha failed to record a cash sale. So they just forgot to do a debit to cash and a credit to sales. Cash increases our assets, sales increase our net income. So assets should have been increased, they weren't, so they're going to be understated. Neither of these accounts affect our liabilities, so no effect on our liabilities. Sales should have increased our net income, so that's an understatement on our net income. 36. Alpha recorded the purchase of equipment for cash as a debit to equipment and a credit to accounts payable, but they paid cash for it, so there's a mistake here. They did a debit to equipment and a credit to accounts payable when they should have done a debit to equipment and a credit to cash. So the debit to equipment was correct, so we don't really have to pay attention to that. But the accounts payable increased our liability when the cash should have been decreasing our assets. So now looking at the answer, the increase to the asset was correct, but cash should have been decreasing our asset. So it should have been lowered when it wasn't, so our assets are going to be overstated. Our liabilities were increased when they shouldn't have been, so liabilities are overstated. And our net income, there's no effect because none of these accounts affect it. All right, 37. Alpha failed to record the purchase of inventory, the purchase of merchandise, which is inventory on account, using the periodic inventory system. So that entry would have been a debit to purchases and a credit to accounts payable, and they just forgot to do that. Purchases are an expense and they lower our net income. Accounts payable is a liability and that increases our liability when we credit it. So neither of these accounts affect our assets, so there's no effect on our assets. Accounts payable never increased our liabilities, so our liabilities are understated. And the purchases never lowered our net income, so our net income is overstated. Cash received from a customer in payment of the existing account receivable is recorded by Alpha as if the receipt was for a current period sale. So what they did was they did a debit to cash and a credit to sales when it was really cash to satisfy an existing receivable. So it should have been a debit to cash, which was correct, but they didn't do the credit to AR. So cash increases our assets, sales increase our net income, AR decreases our assets. So we're not going to look at this because this was correct, but assets should have been decreased and they never were. So our assets are going to be overstated. None of these accounts affect our liabilities, so there's no effect on our liabilities. Net income was increased when it shouldn't have been. So our net income is going to be overstated. 39. Alpha recorded a credit sale as a debit to cash and a credit to sales, but it was a credit sale. They did a debit to cash and a credit to sales when it should have been a debit to AR and a credit to sales. So cash increases our assets, sales increase our net income, AR increases our assets, and sales also increase our net income. So even though it was put into the wrong account, assets were still increased. So there's going to be no effect on our assets. None of these accounts affect our liabilities, so there's no effect on our liabilities. And sales was recorded correctly, and they increased our net income, so there's no effect on our net income. Alpha failed to record depreciation at the end of the current period, so they just forgot to record a depreciation adjusting journal entry, which is a debit to depreciation expense and a credit to accumulated depreciation. Depreciation expense lowers our net income. Accumulated depreciation is a contra asset, so it lowers our assets. And so our assets were never lowered, so they're overstated. Neither of these accounts affect our liabilities, so there's no effect. And depreciation expense was never recorded. Our net income was never lowered, so our net income is overstated. And that is 31 through 40.